I think there's always been, I've sensed some frustration that you have this growing fee base in alternative assets as well. You are talking about getting the alternative business, or at least the fees, over $10 billion in overall management fees for 24, I believe, with about $2 billion from alternatives. Is that being, in your opinion, adequately recognized by investors?
Well, I think investors that have been supporting us see the movement that we've made with respect to management fees and also other durable revenue streams across the firm. But with respect to that fee target, we will hit that fee target. That's a fee target that we set when we did our first investor day. We will hit that fee target. My guess is sometime next year, both in terms of the overall management fees and also the alternatives fees. And we can continue to grow from there. At the investor day that we did in February, just a few months ago, 6 months ago, Mark Nachman stood up and said that he thought we could grow this asset and wealth management platform now that we've really got it together and we've got the right focus on it. We can grow at high single digits. We can improve the margin to 25%. Mm-hmm. You also said that 25% for a business like this from a margin perspective wasn't aspirational. So I think over time, as we continue to grow the business, we've got real upside.
Is there a point at which, David, you think that you get to a fee number, given the recurring nature of those fees in particular, that your multiples go up?
Well, I think if we continue to grow that business, and that business continues to be larger, and the margin structure improves, and we continue our strategic decision to get out of the very heavy balance sheet concentration that we had, which is very, very capital intensive, over time, I think the market will recognize and appreciate that growth and that earnings. And, the firm makes a lot of money, it generates a lot of capital, and that should strengthen our position. But I think one of the reasons why the firm has performed well, when you look at our performance over the last 3 years and 5 years, is we are reducing the capital density of that business. We are growing that business. We've also grown our core business of banking and markets materially, and have taken material wallet share and market share over the course of the last 5 years. And so I think we're in a good position to continue to grow the value of the firm. We've grown it meaningfully over the last 5 years, and we're going to continue to focus on it. As I said earlier, we've accomplished a lot, but we've got a lot more to do.
Yeah, well, you mentioned regulatory scrutiny, for example, as well, David, in particular in the consumer business, but it extends well beyond that. I wonder, does private credit and the private markets have more allure as a result of perhaps lower regulatory barriers?
Well, there's no question that over the course of a long period of time, there's been a significant growth in activity, banking activity, including lending, outside of the regulated banking system. If you look at the mortgage market today, a very significant portion of all mortgage activity is outside of the regulated banking industry. There's no question there's significant growth in private credit activity, and that goes on, by the way, in the regulated market, in the regulated industry too. Goldman Sachs has over $100 billion of private credit on our asset and wealth management platform, and it's a big growth area for that part of the business. I think there's going to be good secular growth in private credit activity. I think given the shift in the interest rate environment and the change in the capital markets that we've kind of gone through and the shift that we're experiencing right now, that's obviously making those markets very, very attractive. So I think that's an area where, one, there's real opportunity for players that are private credit players, but there's also real opportunity for an institution like ours that finances all of their positions, that helps put deals together in that space. And so, there's a tailwind there for us too.
Right, so those who would say you're disintermediated by the areas of the Blue Owls, I mean, I go on the Blackstones of the world who are providing so much private credit. Not the case.
Well, we were never, Goldman Sachs, as you know, was never a huge lending bank.
No, you haven't.
Okay, but
you have financed occasionally.
We actually are a huge financer of those clients. And by financing them, that makes, our value to them, more important. And so that's a business that we've also grown very significantly over the course of the last 3 to 5 years.
Let's talk about M&A and the capital markets. We got a big IPO coming next week. You guys are.
We do have a big IPO. You
guys are lead arm.
We have a few IPOs coming over the course.
Are you feeling better about things?
I definitely do feel better about the capital markets. And if you ask me to kind of look ahead, over the course of the next few months, especially if ARM and some of these other IPOs, go well, I think you're going to see a meaningful increase in activity. Now, David, it's often an anemic amount of activity.
Yeah, I mean, nothing happened.
Nothing. No. I mean, it's really, investment banking activity, if you go back to the second quarter, investment banking activity in the second quarter was a 10-year low. Yeah. And so it's not hard to improve off of that. But I think we could very quickly get back to what I'd call a more normalized level of activity in the capital markets, and that's obviously very, very good for Goldman Sachs. And I see a real improvement. I'm quite optimistic about what I'm seeing.
Is ARM important next week?
Well, it's of course it's important. It's super important to the client.
Yes, SoftBank
so
matters a lot.
We're very focused on executing for the client. But yes, if a few of these IPOs go well, it will create a virtuous kind of system of pulling more stuff forward. There's a lot of stuff in the backlog, and I think we're going to see an improvement in activity levels over the next 4 months and into 2024.